Welcome back to another episode of the Educated Homebuyer Live. This week we had some interesting data. First off, we had the JOLTS report, which came out early in the week, which was disappointing, along with disappointing ISM data, along with disappointing data on the ADP on jobs front. This week we have jobs coming on Friday, Josh, non-farm payrolls, as well as the unemployment numbers. Regardless, we've actually seen this affect interest rates in a positive way, right? All of this negative news has been a good thing for rates. The 10-year has gone down. Bond prices have improved. Things are, moving along. So with that, we're going to talk about it in a little bit more detail. But Josh, welcome back once again.
I'm glad to be here. Another week above ground, so we're doing good. I was going to take exception. You kept saying disappointing this number, disappointing that number, and I said not disappointing at all. It was exactly what I was hoping for because we're vultures in the mortgage industry. We want all of the bad news.
You do, but it essentially shows that the economy is slowing, which is something we've been talking about for months now, but it's now starting to reflect in the data. Chances are, it will likely move further to the downside over the next couple of months, but it's hard to say at this point. Something I didn't mention early in the show, like we always do, we're going to talk about inventory levels. We're going to talk about what's happening in the real estate market. We're going to talk about some other news out there. But Josh, let's start here by, I mentioned the idea that rates have improved a little bit. What have we seen since about this time last week?
About 0.25% across the board would be what we've seen of improvement. Okay. So I would call it about 0.25% across the board. Like I ran the numbers. I always run them before the show just to give you an idea. An FHA standard balance is mid fives with no points, no lender fees. You can definitely get it lower than that if you want to pay some points. About 1/8% higher than that for either VA or high balance. So the government stuff, mid fives, and you're looking low sixes with 0 points, or again, with 1 point today, you can definitely get a 5 handle on a 30-year fixed as long as it's standard balance. That high balance, the 3/4 to 1 point hit on a high balance purchase makes it really, really difficult to get an attractive rate. You go from, like I said, 6% range, 6 1/8, 6 1/4, up to about 6 5/8 when you get to the loans above 726,200. But long way of saying everything about 0.25% better, which we'd kind of mentioned the last few weeks. You see in the news, rates are better, rates are inching better, rates are improving, but they're not actually improving much. It's almost imperceptible. This week we saw a nice about 0.25% improvement.
And even with that said, right, so with the data that we saw today, we did see the 10-year tick down. We saw but the bond market didn't really move quite as much. And you and I were talking off camera a couple hours ago about, more or less need a little bit of confirmation with regards to the non-farm payrolls on Friday. In addition to likely, I don't know that it's going to take until Wednesday of next week to get additional confirmation. But, one thing you've got this Friday is you got non-farm payrolls and employment numbers, which based on what we saw today, likely to come in less than expected. But Friday's also a holiday, right? So it's a short trading day. You only have a couple of hours in the morning to trade. So it's hard to say whether that's going to, leave traders, a lot of traders, again, take the weekend off, right? It's a holiday weekend. A lot of people aren't showing up to the office to actually trade the news. So the question is it built in? Will it reflect in Monday of next week? And by the time you get to Monday of next week, are they thinking, well, we should probably wait a little bit further until Wednesday to get further confirmation from CPI that, the market is slowing? So there's a lot of what ifs, but nevertheless, we like improvement, and that's what we've seen. So I asked you a bunch of questions, didn't really, kind of rhetorical, if you will, but, thoughts.
Just thoughts on where the direction goes. So I told you I have started a wonderful new regimen of getting out and walking for an hour every morning, and that gives me some time to catch up on my listening. A gentleman that we talk about a lot here on the show, Logan Modashami, listened to 3 podcasts that he had recorded in the last 10 days, just about 20 minutes of updates. And it kind of jived with what I was thinking and where we were going with everything. The Fed is still of the mind that a tight employment jobs market with really low unemployment is inflationary. It's going to lead to wage inflation, and we're not getting inflation under control, regardless of what CPI says, regardless of what PCE says. We're not getting that under control until we see some weakening in the jobs market. Well, we're starting to see it. JOLTS reflected it. ADP reflected it. It wasn't a big miss on ADP today. 145,000 versus 200 expected, then upward revision of, I think, 19,000 for last month. So really the net effect, 30,000 less jobs. There were some comments in the release from ADP saying that they're seeing less hours, less wage growth, just weakness throughout the report. And not weakness meaning.
And I think we have some charts on that too.
But you know what I'm saying? It's weakness, not going from a really hot, tight jobs market to a bad one, just weakening, slowing. So the Fed is worrying about something that's not going to happen. And for them to be out of play, we've talked about this in the show, the Fed may pause, but the Fed's not cutting until they see a higher unemployment rate and are convinced that there's no wage-based inflation. So we think it's there. We think we're seeing that. We think we're going to get some more confirmation. Again, not a terrible jobs report on Friday. Like they haven't been blockbuster before, and I don't expect it to be terrible now. But if it starts trending in the right direction, next week we get CPI. This month we've talked about May. The data for April that's going to come out in May is where we expect a nice pop when we start seeing the flattening of shelter inflation. I expect that to come through. So for now, you and I were talking earlier today, this has been pretty moderate improvement for everything for the last month being bond friendly. What we're going to get over the next 4 to 5 weeks, if we get the confirmation that we are expecting, is we'll see a much bigger improvement. And largely, Jeb, we've seen a nice improvement. Where did we peak on the 10-year? It got up to 4% within the last 6 or 8 weeks, didn't it? Or
I don't think so. No, I think the highest in the last couple of weeks was like 3.
No, I said in the last 6 weeks or so. The last couple of weeks, we've been seeing nice improvement. But within the last 6 weeks or so, it's been up. Let's see. We were at 407 and what in the world? Yeah, beginning of March. So in the last month, we were at 4%. So we're down 0.75% in terms of the 10-year. But mortgage rates are down about half of that.
Yeah, the spread's still really wide.
The spread widened a bunch, and we're expecting it to narrow. So if it just comes back in line, we're looking at a good bit better. But I think the 10-year will move slightly lower, and mortgages will follow to a greater degree than they have so far.
So something you just mentioned, unemployment. Typically, we don't get into questions this early in the show. But there is a question here that's a good question that I want to touch on, Josh, from a regular viewer here, asking the question: the Fed has a horrible track record of forecast. If their unemployment rate forecast is also wrong and unemployment goes a lot higher than their 4 to 5% forecast, how would this affect real estate? So question is I don't even know at this point that they're forecasting a 4 to 5%. I think the goal is a 4 to 5% if, in order to bring inflation down. Ideally, they'd like to keep unemployment low and bring inflation down. But with that said, Josh, unemployment goes up 4 or 5%, goes above the 4 to 5%. How do you feel like that will affect house prices? In the short term, in the midterm, and I guess the long term?
My answer, Jeb, is similar to this. Coming off of 3% rates for the better part of 2 years, last January, February, when we're quoting 3.875, 3.75, people are like, that's horrific. There's no way I'm paying that. And then 4 months later, boy, really wish I could have got that 3.75, 3.875 rate. And then today, we're wondering if we'll ever get back to that level. So in a similar vein, it was once considered that 5% unemployment was full employment.
Yep.
So
there is a 6, I think.
There is a percentage of the population that is considered hardcore unemployable. You may have a brother-in-law who fits this description, but they are not capable of showing up every day and not getting themselves fired. So when we're at 3.5%, that's telling you that people that you really don't want working for your company, that you don't want as a coworker, have jobs. So if we get to 5-6% unemployment, we are still at a very solid, healthy point. I believe we hit about 12% unemployment, Jeb, back in 2008.
12%.
We're not going anywhere near that. You have demographics, baby boomers retiring. Many of them retired during COVID early, never came back. Their portfolios did well. And they're like, cool, I'm out. I'm not coming back. Those people are not coming back into the workforce. So we do not have enough people for the jobs that need to be filled. Now, I know the headlines. If you open YouTube, if it's not someone telling you that the housing market's going to crash, they're telling you that Chat GPT is going to change the world and you're all going to die or lose your job.
So true.
I don't think that any of those things are going to happen, but short of that, we do not have enough people to fill the jobs that need to be filled.
On top of not having enough housing supply at the moment to fit the needs of home buyers out there. And, what I'll say is it's hard to say what'll happen as unemployment goes up, right? I believe a large percentage of the population that fits the mold of what Josh said, unemployable, a lot of the people that could potentially lose their jobs, not all, a percentage of them will be at the lower end of the pay scale. A lot of them won't be homeowners to start with. So those people aren't at risk of losing a house. But there will be people that do, without question. And so those people have, a choice to make. Do they go out and get another job? Chances are, if we don't have enough people to fill the current, job market, the labor market, there will be job openings, and therefore people can transfer to another job. Can they get the same job, the same pay? No, I don't know, right? I don't know the answer to that, but there will be jobs out there. So the question is, do you go out and get another job, try to find it, try to keep your house, try to, fight tooth and nail to stay where you are, or do you sell it and go a different direction? It's hard to say. You'll have a little bit of both. But what I believe is that, people that have equity in their homes, have super low rates, those people will be more inclined to try to keep the home before everything else. And I also believe, unfortunately, the government, if it, has made a point to let us know that they're willing to step in and help people in situations like this. So when you have people start losing jobs and that sort of thing, if it becomes an issue, guess what? Probably going to get some support. But nevertheless, that's a whole different conversation. I don't see an opportunity at the moment to see a big decline in prices because of supply continuing to move in the wrong direction. Now, if you see supply increase a lot and you see people lay off, that will bring home prices down. I don't think we're there yet. And I don't see a recipe for that within the next couple of years. Just my thoughts.
Let me, Jeb, throw a hypothesis out there. People look back and they say 2008, we got to 12% unemployment. That led to massive foreclosures. There's definitely a correlation, but it wasn't the causation. Whether you lost your job or not, let me give you the example of the first house that I bought in 2008. We paid $265,000 for it. About 30 months before that, the gentleman had paid $685,000. It didn't matter whether he lost his job or not. That thing reset. His payment went from like $2,900 to $6,000. He could not afford that house. So there was much more of that. We talk a lot about on the show at any given time, about 65% of American households choose to be homeowners. Well, our government, Republicans and Democrats throughout the late 90s, early 2000s decided that homeownership's good, so more homeownership is better. We pushed that rate to almost 70%. So much like the hardcore unemployables, when we have a 3.5% unemployment rate, we have people that had no business owning a home. And they likely had a crazy loan to make it happen that enabled their terrible FICO, no down payment, no savings, time bomb with an adjustable rate in there. And that all combined in there is what happened. So I wouldn't look too closely to unemployment. There's clearly a correlation there. There will be people who had good jobs, bought late in the cycle, didn't put a big down payment and find themselves in financial trouble. But the reality is most of the people that are going to lose their jobs are either at the lower end, not having homes, or one spouse has an issue and the other one still has a job. They have some savings to rely on. They can sell the house. It's not a foreclosure. So I don't think it's anything like the recipe, like that perfect storm that we had in 2008.
All right. Well, this is where we're going to transition, start talking about some things that we talk about every week, just to kind of keep it, comparable to week over week. And the first thing we're going to talk about is inventory. So inventory, basically unchanged from last week. National inventory sitting at about 413,000 homes. Typically, again, this time of year, we would see inventory continuing to tick up. Primary reason that isn't happening is because new listings are not coming on the market. We saw a tick up in new listings, and then we more or less saw some sideways, almost downward movement in the new listings week over week. New listings not coming to the market is keeping inventory levels down. Again, you see it here, only 66,000 new listings compared to 82,000 new listings last year. So new listings are down. And even with that said, 16,000 of the listings coming on the market went into escrow immediately. So coming on the market, they're gone immediately. In turn, inventory isn't building. We talked about this one. Median home price is continuing to increase just a bit, sitting at 437,500. Median price of new listings also going up just a tad. Nothing crazy week over week.
Jeb, hold up. Go back to that one, because
Yep.
I'm sure that some people watching are saying, dudes, 2 weeks ago, you were just telling us that the median home price had dropped, and that's not a good barometer of what's actually happening in the market. So explain how this has gone up, what this chart is, and how it is going up and showing an upwards trend.
What do you mean by we talked about median home prices going down? Are we talking about the
2 weeks ago, we had a report that the month over month median home price nationwide had decreased.
Yeah.
And so when you're looking at this, I don't think everyone follows along and knows the differences in charts, timing, and what we're looking at. So just clarify for anyone watching how this is not contradicting what we talked about a couple.
Yes, I mean when you're talking about month over month decreases in home sales or year over year decreases in home sales, you're getting national reports from different agencies. I'm trying to think of one right at the moment, not Case-Shiller, but who do you have? You have because Case-Shiller is more or less the gold standard. Who are we talking about here?
Black Knight has one.
Black Knight showed an increase. I'm trying to think of who were the decreases. I can't think of the. Nevertheless, the way they use analysis in looking at the median home price, right? So when we talk about median home price, the reason median home price declines, if you will, is because you have more homes selling at a lesser price than the median, therefore bringing the median down. Josh and I have talked about this in the past. When home prices are increasing, the median is also off, right? It's never necessarily an accurate number because of the way it's calculated. Case-Shiller and what's the other one out there that uses the comparative? Go ahead. You said something, Josh? CoreLogic use a sales approach method where essentially they take the same home over time and see how that, the sale of that property increases, decreases in order to correlate it to prices going up or down. Therefore, this past month, when we looked at Case-Shiller, we actually saw a bit of an increase in home prices because of the way that's measured. It's gone down from the increases that we saw, but it's still moving upward. So basically what this is showing you that new homes coming on the market now, new listings coming on the market now, the new prices, the new median is moving up with the new homes coming on the market. Okay. So just shows you that prices aren't necessarily declining. So you have more homes, again, above the median price coming on the market that in turn pulling that median home price up. Does that make sense?
Yep.
Or not. But the number below it is the median price of new listings. So the median home price on top, the median price of new listings. So you could see from that chart, as the median price of new listings goes up, it also pushes up that median price because, again, it's, the median is based off properties below and or above selling at a higher number and therefore reflecting in that number. So nevertheless, hopefully that makes sense. Median price of homes in contract. So now this is a little bit different. So you've got the median price moving up, but you've got the list price of homes in contract a little bit less, right? So that means it's down 1.3% from this time last year. So last year you saw the median price continuing to go up of homes in contract because, again, people were bidding above, doing crazy things. Right now, we have more of a flattening. And that's because, again, some markets out there are seeing a slowdown in the housing market. People are able to offer less than the asking price, therefore getting it at a reduced price. Other places are still having to do multiple offer situations, go above the asking price. And in those markets, it's going to be a little bit different. So we talk about it every week. Real estate's local. So make sure you understand the dynamic where you are. Earlier in the show, I didn't mention this. I meant to, but when we look at inventory here in Orange County, we're sitting at 2017 properties. Last week, I think we were at 2080 properties. Okay. So we're continuing to decline in our market with the number of active listings. Huntington Beach is actually up a little bit week over week by a few properties. I think 3 or 4 from this time last week. So overall, Orange County inventory coming down. Huntington Beach has ticked up a little bit. So just know your market. If you've got a big spike in inventory, then that is going to reflect probably in sellers having to reduce prices, doing things in order to sell homes, which we're not seeing at the moment. What we're seeing is competitive markets, and we'll talk about that more as we go throughout the show. But again, price cuts, it looks like it's inched up a little bit from last week, 3.4% last week, 3.5% this week. So nothing really to report there. We talk all the time, Josh, about people moving out of the state of California. Well, all these people moving out of the state of California bring home prices down. So let's talk a little bit about migration, what net migration is, and talk a little bit about where people are moving.
Yeah, if you look at that chart, it shows you a couple things. What I would say is if you look at the top right, those are cold places, people leaving cold places and going to the bottom right, warm places. Mm-hmm. They're not going to the bottom left because those warm places are too expensive. People there are fleeing the really expensive areas. So you look at Seattle, super expensive, highly appreciated. Bay Area, super expensive, highly appreciated. Southern California, super expensive, highly appreciated. We will make no comments about the politics of those 3 crazy cities, areas.
Because no, I think you should.
It has some impact on that, but I would say the affordability is a much bigger issue than the politics of those areas. Politics is definitely a part of it, but the economics of those areas is a bigger deal. But if you look up there in Portland, Oregon is the craziest city in the country, and people are leaving there. Companies are leaving there. Walmart closed a bunch of stores. Nike's closed a store. A couple of other companies they're like, no, we're out of here. You guys won't enforce the laws.
But Josh, I think we can go back just a moment here and talk about politics without talking about politics, right? So the thing you're not wanting to mention, or it's not that you're not wanting or mentioning, is the states that people are moving to are red states, right? Republican states. Take California example, Democratic majority in the state, super majority, right? Crazy things happen here in the state of California because you have a majority. A super majority in any state is not a good thing. I don't care which side it's on. Republican, Democrat, doesn't matter, because that means one party is making all of the decisions. There's no bilateral, agreements. There's no back and forth. There's nothing. It's just, hey, we put this on there, more or less it gets passed and we move on. But people don't like that, right? And so, a lot of the red states that people are moving to, it's not necessarily the politics, but it also has to do with the taxes that are associated with that, right? And that you could say that's political, whatever, but a lot of these states, Tennessee, Florida, have no state income tax, right? People want, not only do they want better weather, but they also like the idea of less tax. And therefore, you're seeing people get out of, more blue states and head to red states for that reason.
Well, I mean, the craziness is, thinking in terms of California, again, without stating politics, our governor is a hard left liberal. He is the voice of reason in Sacramento. The uniparty that controls the House and Senate in California, he's reining them in of the crazy, crazy shit they want to do. So that tells you that not only is it not centrist, I mean, the population, largely based in the San Francisco Bay Area and largely based in Los Angeles, is left of center. So, okay, maybe your politicians should represent left of center. but that's not what we have. We've got ultra hard left people that are insane. Jeb, you were going through the mansion taxes that we have throughout California that are popping up. And what is like, here's the thing. It is super easy for someone to say, I can tell you I'm never going to own or sell $100 million home. So is this my issue? Should I be concerned about someone having to pay a 2% tax when they sell their $100 million home? And is it really going to hurt them? No, it's not. But that doesn't mean that it's right to take it from them, or that the voters, 99.9% of whom will never be in that situation, can say, I vote to confiscate what you have. And you may disagree, but we all agree there's a line somewhere, and we have crossed the line on California, Oregon, Washington, where it's just open season on anyone who has more than I have. That's the line. If you're on the other side of the line of having more than I have, it is fair to tax you so that I can have that. And the line might be at $20,000 a year income, might be at $250,000 a year income. But we keep having a line where anyone with more than I have is entitled to have theirs confiscated.
Yeah, no, I agree. I don't have anything more to add to that. I mean, in LA, if you sell a home more than what I think $10 million, and again, like you said, people are going to say, well, people that have $10 million, they deserved it. Well, I don't agree with that. But 5.5% tax on top of whatever they're already getting taxed. So you sell $100 million property, $5.5 million just because we wrote it into law and changed the tax code from when you originally bought your house. That's crazy. I mean, yeah. But nevertheless, whatever. We'll move on. National average office occupancy level. So we're going back to what the far left on that chart there. We're not talking about politics anymore. The far left, July of 2021. You could see less than 20% of people were in an office, and currently today we're at just over 50%.
Yeah,
but that's a big problem because
look at the very
left.
Yeah, pre-pandemic, that's close to 100% occupancy in national average offices. Drops down under 20% when everyone's on lockdown. No one can go to the office, and we've slowly crept our way back up to 50%. And that, Jeb, leads to your next chart, and something that John Malden has been all over this for about 3-4 years now. And he did not say this is going to happen tomorrow. He said at some point in the near future, we are going to have a problem in the commercial mortgage segment. And that go through that chart, Jeb.
Well, I mean, it's important to know, right? I mean, we talked a little bit about it last week. We talked about commercial mortgages, commercial real estate, and the future of commercial real estate, and how, talking about a shoe dropping, that could really be the one for a couple of different reasons. But this chart right here shows, well, it says it at the top, right? Smaller bank share of domestic commercial banks, commercial real estate loans. So just basically shows you that small banks out there are holding close to 70% of commercial loans domestically here in the US. That's a problem in the sense that if you start to see defaults in commercial, and we'll talk about why you could see that here in just a second, but that could be further strain to the banking industry, further strain to commercial real estate, clearly, because that, the defaults in commercial real estate will affect further commercial real estate. And you talk about why would that happen? Well, you looked at the chart previously and said, okay, only 50% of people at this point have made it back to an office. Okay. Will that increase some more? Sure, it'll probably increase some more, but that leaves a good percentage of office space out there vacant, which means nobody's paying rent on it. When you're not paying rent on it, that's going to affect your ability to repay. Even if the property value is there and the property value has gone up, doesn't make your ability to repay that loan any better. And you're saying, okay, well, how does that translate? Well, a lot of the commercial loans that are out there, I don't know what the percentage is, Josh, but they're adjustable rate mortgages. Right. So you're sitting on, I don't know what is the typical term on something like this? A couple years, 5?
3 to 7. 3 to 7. Okay. Most of them are in the 5 to 7 range.
So we'll say on average 5 years. So 5-year span of commercial loans that are adjustable, they're going to adjust. And if they adjust anything like everything else out there that's tied to, any of the indexes that are, again, affected by the Fed raising the Fed funds rate, which all of them are, that means a higher monthly payment in the future. And if they're having trouble now, vacancies now, what does that look like in a couple of years? I'm asking you. Mr. Lewis?
For office buildings or for houses?
For office. I mean, we'll talk about it affecting housing here in a minute. Or if it affects housing, but what are your thoughts on that commercial space?
Look at it this way. If you own a 2, 3, 4 unit building, and it's vacant for an extended period of time, so that when you go to refinance your mortgage, your tax return shows that you're losing money because you're not collecting rent, you're going to have a very hard time getting a loan. So it's not just that these are resetting. It's that they're vacant and they've been vacant for an extended period of time. So when you give up your financials for that building, the income that the building is generating is not there to support qualifying for the loan. So you do have something very similar to 2008. It wasn't a liar loan where someone said they made money, they didn't, and then 2 years later needed to actually qualify for the loan. These people did qualify at 100% occupancy. They don't qualify at 50, 60, 70% occupancy. So it is going to be problematic. Those problems are going to fall back on smaller banks. And the reason why this is important, 2-3 weeks ago, we had the Treasury and the Fed get together and come out and say, we're going to step in and guarantee the deposits of systemically important banks. These little small banks don't fall into that category. It's not to say they can't do it, but they don't fall into that category. So what happens is depositors that have their money there are saying, maybe I need to move to one of the big banks that's systemically important. So these banks are getting it from both ends. Money is coming out of their banks and going to other bigger sources, and they have loans that are likely to go bad and be hard to refinance. There's no good recipe for this. And add that, one of the fun things that Fed Chair Powell said is, we aren't building enough homes, but it's okay. We have a lot of vacant office buildings. We can convert those to condos. So when you're that out of touch and that's what you're saying, it's not a good recipe. These loans will get redone. They will get written down. There's going to be a lot of losses. People will lose buildings. Banks will lose money on those loans that were made to them. They will take them back and sell them at lower prices. Some of them will get redeveloped into other purposes. Some of them will become housing, but not all of them are even possible to do that. So there's nothing good that can come out of this.
Agreed. So let's talk about this. Josh, we talked a little bit about this data earlier. Anything further you want to add to it here?
It gives you numbers. So we saw the Institute of Supply Management Manufacturing Index was expected to be 47.5, came in at 46.3. Today, the more important one is their non-manufacturing index came in at 51, was expected at 54.5. It was 55 last month. So it's telling you that all of these are trending down. JOLTS is another look at the job openings and labor turnover. So again, 632,000.
Right. Yep.
Yeah, 632,000 less from January. That's a pretty quick and rapid turn when the Fed has been saying, hey, we're panicked, we're scared, we're worried that we're not going to be able to control wage inflation because of how strong, unexpectedly and unexplainably strong the employment market is versus seeing it coming. So the other one I wanted to throw in there, nearly every number that we saw this week, the two big ones, Black Knight came out, home prices up 0.2% in February, homes for sale down 27%. So homes listed for sale, much like the charts Jeb led off with, down 27% from prior to COVID, which wasn't super robust. We didn't have a lot of homes for sale before then, but we're off 27% from that. We had, I was running late here and didn't get the charts put in here. I take CoreLogic with a grain of salt. We laughed at them. You remember here on the show during COVID, they kept saying, first they said in 2020, home prices are going to drop 6%. They wouldn't give up on that. They came back the next year, 2021, home prices are going to drop 3.5%. I think they finally came out and said 2022, home prices will go up 1%. Now they're forecasting that we're going to be up 3.7% in the next year. So you look at all of the numbers, they're all kind of confirming what we've said. No one is sitting here telling you it's a robust housing market and we're going to have massive appreciation and owners are going to be, counting their additional equity. We don't have a recipe for a downturn. We don't have a recipe for a crash. We have a recipe for slow growth, especially with all of the things that we're saying here leading to lower interest rates will put more support under home prices. So slow growth, sideways to slightly upwards trend in housing for the foreseeable future.
Yeah. And here's another chart just showing you, job workers gap, the difference between some of the overall employment and job openings, obviously coming back down. Josh, we got, is this the bonds? Is this
that's the 10. That's the 10-year right there.
Okay.
And it's the
Okay.
weekly chart. So we usually show the daily. The weekly kind of takes out some of the noise of what happens from day to day. So what we've been talking about, a month ago, we had a big drop week over week. Like I said, we were up around 4% and dropped a big drop the following week. And then you've just gone sideways for the last month. So we've seen another leg down, and that yellow line there is the 200-day moving average. The 10-year is well below the 200-day moving average. That tells us we are into a longer term trend change. So Jeb, if you go to the next one is the 5.5 mortgage-backed security, and you see the gold line is also the 200-day moving average. We touched it today. That's a weekly chart, but that touch was today, this morning, and backed off in the afternoon. We have not broken through that 200-day moving average. I expect that the 10 is going to stabilize somewhere in the range of 325. And when it does, mortgages are going to follow. They're going to push through that 200-day moving average, and we should have a sustained downtrend. I don't expect rates to drop like overnight and go super low, but I do expect a sustained downtrend over the next 3, 4, 5, 6, 8 months until we get to something approaching the new normal. 3% wasn't normal. 7% wasn't normal. The market needs to find what normal is between those two poles.
Good stuff. And then a chart that has absolutely nothing to do with anything other than if you live in one of these areas, you probably want to move to a blue area. So this shows you life expectancy in America. Average age going from 66.8% in the dark red to, if you're in the dark blue, you're 86 years old, almost 87 years old. Josh, we're looking good here, man.
We're not moving. We may hate the politics, but we're going to live a long time here to bitch about it.
We're doing well on the West Coast, down tip of Florida. Basically the outskirts of the Southeast. It's pretty much screwed outside of the tip of Florida there.
Do you want to know what the answer is for all that red in the deep South?
Hard work.
No, sweet tea.
Sweet tea. Get out of here, bro.
Sweet tea and obesity explains all of that.
Obesity, you might explain it. But yeah. All right, guys. So I know that took a long time to get to your questions, but I do want to say thank you guys for being here every week. Thank you for the continued support. We've had a lot of questions. Probably going to get some tonight on the Dream for All program. Anybody here in California? As we promised last Friday, we put an episode out on the Educated Homebuyer podcast and the YouTube channel addressing Dream for All. So if you have questions, go check out that video. Go back, look at it. There's a lot of information out there. I know there's some questions here. We'll talk about it as we go through tonight. In addition, a lot of you guys are always asking about refinancing. When's it a good time to refinancing? That posted Tuesday of this week on the Educated Homebuyer podcast and the YouTube channel. Go check that out. If you're not subscribed to the YouTube channel, go subscribe. That would help us out. And go listen to it. Also, FHA versus conventional. We recorded that today. It'll post next week. So that should help you guys get the stuff that you want. But if there's anything else you want to hear, let us know. All right.
Jeb, on that note, the episode today, FHA versus conventional, was really, really good. Jeb has done comparison videos. He's done FHA videos. He's done conventional videos. I think the format of a little longer conversation and some back and forth, it just allows you to go a little bit deeper on it. And so what I'm suggesting is watch all of Jeb's videos on FHA and conventional, and then watch that as sort of the capstone to get your PhD in FHA versus conventional.
There you go. I like it. All right. Let's see what we got here. Round Earth is starting by saying the Fed is behind on the curve again. They are making the opposite mistake they did in 2021. Inflation is over. Recession is the much more serious risk. Yeah, I mean, the recession's coming at this point. It's just a matter of when they will actually admit that it's here. So,
the question is how long and how deep.
How long and how deep? That's a shit.
Hey.
You see? All right. That's funny. Can't say that. This is a family show. Are lenders at risk of going out of business? I think this is a good question, Josh. I think
the small banks that we just showed in the chart previously with the commercial loans.
No, but even let's talk about the third or fourth largest lender in the United States. HomePoint.
We're not allowed to talk about that yet.
We're not. Never mind. We're not talking about anything right now.
He did not say anything about that. But let's just say going out of business, no, because even the lender that you didn't just name, it was a business decision. They didn't literally have to do it. They chose to no longer lose money at the rate that they were losing. So we have creative destruction in the mortgage business. I said for the last 2-3 years, like, why do half of these lenders exist? They don't have good technology. They don't have good service. They're not competitive on rates. They have the same products as everyone else. So there is a good and welcome and needed shakeout in the mortgage industry. That's not related to the economy as a whole. It's related to the volume of mortgage loans, and we have an absolute recession in the mortgage industry. We've lost jobs, lots of them. We've lost companies, but that's not necessarily a bad thing, and it's clearly logical. We pulled a bunch of demand forward from future years. Lots of people who would have bought in 2022, 2023, 2024 bought earlier than expected because they had an opportunity with really low rates and they saw home prices going up. So that, combined with the fact that sellers aren't selling, those sellers would likely buy. We have way less sales. We have less inventory. This is to be expected. I don't know that it's going to correct or go back to normal anytime soon. If we say like 2015 to 2018 was what a current normal should look like, I don't know, Jeb, that in the next 10 years, we get back to that. So is it a problem? No, people will go find jobs in other industries. The best people will stay here. The best companies will survive, and we will be fine. So in terms of are lenders going out of business, and is that systemically important? Is it an issue for you in terms of not being able to get loans? In the current market, absolutely not. 90% of loans go to the government in one way or the other: Fannie, Freddie, FHA, VA, USDA. So the government's not going anywhere. They want homeowners to be able to own. So they're going to continue lending, and someone will find a way to make a profit off of that. And we need less companies in this industry. So in the short run, it's keeping prices lower than they should be. Lenders are losing money on every loan that they close. So in the long run, your price will go up, but it will more accurately reflect what it should have always been, sort of like the Uber prices going up over the last couple of years.
Holy cow. We took a question like that and just turned it into a 3-minute conversation. Anyhow,
they got questions. I got answers, Jeb.
Oh boy, this guy loves to talk. Eric is watching us from the comfort of his couch with a broken back and a toe. So Eric, we need to know more. What happened? Hopefully you're doing well. I mean, you're at least texting or talking through a computer to type onto the screen your message. So we'd love to know what happened there. Wishing you well wishes, prayers and positive vibes and all that good stuff. So appreciate you watching. Josh, we got Jay. I was about to say Jay saying FHA interest rates are up again, 6.6%. So that to me seems a bit high on the FHA side. I'm thinking FHA rates, if I had to guess, are in the mid high fives, 5.5, 5.75%. Is that fair?
We talked early in the show. Yeah, down about 0.25%. So anyone that's telling you that rates are up, or any index you're looking at that says rates are up, is woefully out of touch with where the market is at. Even if you say the rate is 6.6%, then that means it should have been 6.85% last week. Definitely not up. What you will find, we talked about it in the show today, Jeb, that government loans, FHA, VA, because they have a full government guarantee, have lower rates than conventional loans. But what you find, a lot of direct lenders actually use FHA and VA loans to pad their profit margins to do really thin conventional loans. So most likely, Jay, what you're doing is talking to a lender with really, really high margins on their government product. Talk to a broker, because again, 5.5, 0 points for someone with a 640 plus credit score today.
All right. This is a good question, Josh. Pulse Powered asking any updated numbers on the Dream for All program, how much funds are left. So let's tell the quick story about an agent that we both know up in the Lancaster area, had a property in Bakersfield, listed it this past weekend. It was on the lower price point side for here in California, just what, 300, under 300,000.
Under 300, yep.
He had 14 offers, 10 of them were Dream for All. So out of 14 offers, 10 were Dream for All. That to me, I don't know why I'm mind boggled by that, but I am. I mean, hell, the program just came out on the 27th. We're talking 10 days into this thing, and you've got that many people that have already been pre-approved and ready to go on it. So, wow. But Josh, funds, you heard that the funds are going quicker than they had originally anticipated. Is that right?
So no one's posting it. So like Cal HFA is not posting the numbers. So this is all hearsay, but from good trusted sources, my understanding was as of Monday, they'd already gone through 100 of the 300 million. And we're thinking as of today, we're approaching half of the money being reserved, not gone. They haven't closed the loans yet, but they're reserved for those people. So if they close, they have funds available to them. So
And what do you need to reserve with that? Do you need a property?
Yep.
Or you just need to be approved?
Fully executed purchase agreement. They will not reserve funds without you having a property under contract with an open escrow.
All right, good stuff. Anya, one of our regulars here, says, is there a minimum mortgage loan amount? Is there a minimum square footage for a small house, not necessarily a tiny home? So this would be news to me. I'm not aware of a minimum square footage. I know there's kind of minimum loan amounts for a lot of lenders out there. I know you can go to your bank and get smaller loan amounts, Josh, but what are the answers to those?
FHA is 400 feet. They want the house to be bigger than 400 square feet. That being said, conventional, it has to be typical for the area. So if you have a 220 square foot studio and everything around it is 1,000 square feet, it can be problematic depending on what the appraiser does with it. You know, and actually, it doesn't come up very often. It's very rare that you see properties that small. So the 400 square foot may actually be a manufactured home guideline. As prices have gone up, we're seeing more and more of these. Closing one right now that we're trying to get docs out tomorrow. So I'll have to actually research to tell you for sure. That may be a manufactured home requirement. But for the most part, it just needs to be common, typical. It needs to have all of the things. You have to be able to cook. You have to be able to heat it. You have to be able to go to the bathroom. Loan amount is lender dependent. And what happens is our government, trying to keep people from getting screwed on loans, have set limits on what can be charged. And on those little loans, anything under $100,000 is really hard to do it in a compliant manner and actually not end up paying money to do the loan. So what you end up seeing is credit unions, community banks do a lot more of those on a relationship basis with clients in their community, versus if you come to us, like, I don't know that I could do a $50,000 loan and be compliant. Like, we can't get it to pass the tests just because of the fixed costs involved in it. If I wanted to make nothing, it would still be really hard to get it to pass the points and fees tests.
All right. Willing, another regular on here, says, if you worked 1 year as a processor and received some bonus incentive pay and then got promoted to a loan officer and worked for a year and received some commission, can you use prior bonus pay from the prior job so that you can show 2-year work history? Would this work? Or does it have to be 2 years from the same job to use commission bonus?
If you switched jobs, so you worked as a processor for one company and an LO for another company, it would probably be problematic. If you had a really good loan officer and could make a really strong case and the rest of the file was really good, you might be able to get it through. This is a situation we talk about, to be determined underwrites, where you actually put the package together before you have a property and send it into an underwriter. You would probably want to do that. Now, different route to go if it was the same company, you're processing and they give you bonuses, and then they move you in an LO position and you have a salary with bonuses. There's nothing on the verification of employment form that we would need to verify and average the bonuses and overtime and commissions and anything else that you have in there. So it would just say loan processor, and you worked there for these years. So most likely you would be fine from that perspective, because there's not really a form to say, hey, did this person work in a different position within the company?
Good stuff. Let's see here. Patrick's asking, with all the recent short-term rental regulations taking place, how will this affect real estate investing in our opinion? So this has always been a concern for markets out there that have a lot of short-term rentals, is cities putting the kibosh on it, changing regulations at some point in the future. If the majority of people buying in those markets are short-term rentals and they change the guidelines for them and no longer allow them, that becomes, again, problematic, to use Josh's favorite word there, and could cause people to have to sell them, because a lot of these properties don't work financially, cash flow wise, when they're just normal long-term rentals. They only work because they're short-term rentals. in many cases. So that could create problems. I'm not aware of a lot of markets making those changes. I mean, Josh, you could speak to it a little bit more where Rancho Mirage went from allowing short-term rentals to now requiring them to be at least 28 days, 29 days, something like that.
28. So
28 days. So what have you seen out there with people having short-term rentals?
Absolutely affecting the market. Just things would go really fast before, because someone would be able to justify it. And I could give you guys our example. When we could do, we never did anything shorter than a week, because I didn't want the turnover. I didn't want someone coming in for 2 days partying and taking off. But with a week, we own it with the in-laws. We use it ourselves, and we like the flexibility of, hey, we can go in for 2 weeks and then rent it for a week or two and then come back in. Now, with it being monthly rentals, we have to sit here at the beginning of the year and say, what period of the season do we want to be there? And then you're limited to what you can get. And for us, the weekly rate, 4 weeks at the weekly rate was like 150% of the monthly rate. And the monthly rate on a short-term rental, so a seasonal rental of the monthly, is probably 2.5 times what the standard monthly rate. We get $8,000 a month for the thing, and it's maybe would rent for $2,500, $2,800 if you did a standard rental on that. So Rancho Mirage is not unique in this regard. Many cities putting significant restrictions on it. Jeb, we have a joint client, I believe, actually came from the show or your YouTube channel, and he's looking in a specific city that does allow them and does permit them and does have permits available. A lot of the areas, they grandfathered in whatever was there, and they'll limit the permits over time as those permits expire. So I think it will definitely, part of this, the ability to do short-term rentals led to the increase in home prices in areas where short-term rentals were in demand, and not being able to do them or limiting them will limit the values going forward.
Good stuff. John Pham, we're both young dudes now. Josh, must be the haircut. I got a haircut. Josh looks exactly the same. Not sure. Maybe a little bit of tan. No, he's still pretty pale. Not sure. Maybe it's the walks he's doing in the morning. You look, they're already impacting your
Probably
quality.
Slimming me down and whatnot. And they got a glow about me. Yeah.
Let's see. We got Kim asking, can you guys explain what is fractional home ownership? So fractional home ownership is something that is getting banned in Newport Beach at the moment. I believe it was on city council. It either got banned or is in the process of voting to get banned. But essentially what it is where multiple people go in and buy a home together. So let's use Newport Beach here in California as an example. You know, the average home in that market, I wouldn't say the average, a lot of the homes in that market are $2 million and above. And so what you have is 10 different people go buy that property together, all put in $200,000, and they own it as one entity, if you will, fractional ownership. They all have a piece of the pie. Now they could use it in a couple of different ways. It could be a rental, and they could all split the income. They could be fractional in the sense that they all get a percentage of time to be in the property. The 10 people divided into 360, they all get a month just over a month to be in the property. So that sort of thing. So it's a lot of places are frowning upon it because they look at it as almost like a short-term rental situation with high turnover. And that's what's happening in Newport, and they're trying to prevent it from taking place. I saw another good question here, Josh, that was related to the Dream for All that I thought was a really good question. It was a very basic question, but it was good. Jessica asked, what do sellers think of the Dream for All? So for those of you outside of California, this is a program that California has put into their budget where they're essentially granting or gifting with a repayment of up to 20% of the down payment to purchase a home. And so, there's $300 million in funds, and the money is going fairly quickly. I don't know the answer to that, Jessica, because I have a couple of buyers that fall into this category that are looking at property right now. We haven't put in an offer yet. I have to imagine, if I were to guess, if I were a seller and I had multiple people, say a multiple offer situation, because a lot of homes here are multiple offer situations at the moment, multiple sellers putting 10, 15, 20% down, and they could document the funds. And then I've got the person that's doing the Dream for All, getting the funds from the state. I have to think that the people are going to go with the people that actually have the money in the bank, because in their eyes, that's an easier close. They don't have to deal with the state. They don't have to deal with that sort of thing. But I can't speak to that for sure because I haven't been there. Josh, any thoughts on that?
Had it come up today. Have a client who they're in an FHA loan, pre-approved for an FHA loan, pinned at that 56.9 debt to income ratio. If we go with this program, they can pay off all their debt in lieu of putting a down payment and closing costs. And it's just a much better deal for them. We make the offer. The listing agent calls me and says, hey, I just did a training at our office on this yesterday. And she asked me 3 very good and accurate questions. And I said, can't argue with any of those. They are all true. She said, well, here's the deal. My sellers are moving to Texas. They're moving to San Antonio. They need to know with certainty they're going to close on this date with this much money in their bank account. She says, I'm not saying anything bad about you. I'm saying based off of the Cal HFA people that we talked to yesterday, you cannot give me that certainty. So we, at a minimum, want them to have a backup option. Tell me they qualify FHA and you can do it that route. So when we get off the live here, we're going to be talking to both of those agents and see if we can hold that transaction together. And it may end up double app with the Dream for All and go with the standard FHA, and we will see how it shakes out.
But that in that case, that means they have to get 2 appraisals, right? They have to get an FHA appraisal. They'll also have to get an appraisal there. So a little bit of added cost to them, but the potential to save quite a bit of money, right?
Yep.
Okay. Yeah. Good stuff. Let's see. And then you go on to ask Jessica, would they prefer a buyer with a traditional FHA or conventional? I don't necessarily know that. I think it's all about how, again, we talked about this in the past, when people make offers on properties, how well educated the agent is that's representing that seller and how they can convey to that seller how the program works. I think that's a big portion of it. And I don't want to speak badly of my peers, but there's a lot of people out there that do sell homes that aren't in the position to be able to give the sellers the confidence that they need with any type of program, much less this, and that could create additional issues. Willing asking another question about 1031, essentially saying, is it eligible for a vacant land loan because the purchase of land would be considered investment? So here's the thing. I believe the answer is yes. You can 1031 the sell of a property into land. But what happens is with a 1031, it has to be a like-kinded exchange, right? So it has to go from, say, residential to residential, or from that sort of thing. So with that said, does selling a house, putting it in land, classify as going from the same type of property to a like-kinded investment? I would say the answer is yes if the land is built for residential, but I can't say 1,000%. I'm also not a tax professional, so that's a tax question as well. Josh, do you have any insight on this?
My understanding is the definition of like kind is anything held for investment, trade, or business purposes. So the fact that you had it's a speculative investment, a rental property, you're going to put someone in it, it's going to generate income, whereas the land, you're hoping it goes up in value. But my understanding is you're okay with that. But as Jeb said, talk to a tax professional, not 2 guys on YouTube.
Good stuff. Good stuff. Eric got back to us, had a brain seizure at 4 a.m, fell out of bed. His house is built on a slab, has no give whatsoever. So crazy, man. Sorry to hear that.
That's a brain seizure is very serious. When he initially said, I didn't focus on the broken back part because that sounded terrible. But when he said broken toe, do you remember the viral video about 10 years ago of the LA Beast that did the butter challenge, that he drank a Slurpee and then ran across his kitchen floor? Well, anyways,
did you see this on
Tosh.0?
On Tosh.0, I remember seeing it.
He broke his pinky toe.
Oh, dude, they showed it.
It was amazing. So I was worried that Eric had broken his pinky toe, LA Beast style. So now everyone's leaving the stream to go look up the LA Beast video.
People, just be weary of what you will see in doing that. Yeah, that's all I got to say about that. Let's see. Orange Pulp regarding rental housing going up like the 70s. Reading about rental housing going up like the 70s. Anecdotally, seeing several rental communities going up around me. Thoughts on how that affects home prices. If it's a rental community, a rental property, like we have properties that are going to be built in Huntington Beach, how does that affect the housing market? It doesn't really. I mean, it just shows you. I mean, basically what they're doing is they're building more property for renters versus building them for homeowners, which more markets need for homeowners than they do for renters. So I would say that it only helps the housing market because it doesn't create additional supply on the market. But if those properties at some point, a lot of the condos, a lot of communities, like let's say condos, for example, a lot of them are built to specs to be able to sell at some point in the future. So if some of these properties are later turned over to supply to sell, that could create issues in a market because you could have oversupply, or you could have builders, for example, building spec communities and selling them to bigger investors, at which point they could at some point in the future turn those into rentals. I mean, this is all speculative. So it's hard to say, but if it at which point in the future they become for sale, that could create issues if there's already a lot of supply on the market. But for the foreseeable future, I don't know that it does. Let's see here.
Jeb, if I've seemed slightly distracted, it's because I got a message that a lock extension for a lock expiring today was rejected, and now we're after hours. But they just fixed it. They just corrected it for me, and it would have been fine because we're lucky that rates have decreased since the time that we locked. But was in a slight bit of panic for a buyer.
No need to be concerned, Josh. We'll just keep pushing them out until rates improve. Home market moving closer to a breaking point. We do not have affordability. Some paying up to 50% of their income to mortgage payment. Short sell soon. Unemployment to climb sharply. So, Josh, I'm not even sure why I clicked on this. It was starred here, but let's address this. We've talked about it a little bit earlier in the show. Affordability is clearly an issue for a lot of people. What is going to keep home prices from declining sharply, like is mentioned here?
Yeah. What has to happen for the 9,000th time is a supply-demand imbalance. More of a supply for homes available than buyers to buy them. We're nowhere near that. So go to the second part of the question there. Short sales soon. What is a short sale? A short sale is a borrower owing more than the home is worth and having to go to the lender saying, hey, I would like to sell this. Would you give me a reduced payoff so that we can have a sale, versus you having to go through the trouble, cost, expense, time of foreclosing on me and then reselling the property. We're sitting on record levels of nested equity. Homeowners have more equity than ever in the history of the United States. Average interest rate on homes for those that actually have mortgages. And what did you say, Jeb? 36% own their homes free and clear.
No, it's like 48%.
It's an absurd number that own their homes free and clear. So clearly no short sale there. Of those that do have loans, 90% of them under 5% with more equity ever than in history. So, explain to me the Armageddon that's going to occur that those people end up underwater and have to have a short sale or have some massive cascade of large. So we say moving closer to a breaking point. Like, honestly, I don't say this to be mean, but it sounds like someone wanting home prices to be much lower. The second question there, or the second point, we do not have affordability. 1,000%. Affordability is at all-time lows. We went through very good period of affordability in 2019 when home prices were more reasonable and interest rates were very moderate. So home prices through 2020, 2021, 2022 continued to rapidly appreciate, and it didn't affect affordability that much because we had record low interest rates. Now we get the double whammy. Super high prices after a period of extreme appreciation, 115% in the last 12 years, Jeb? And then just in the last 15 months, interest rates have doubled. So affordability is absolutely an issue, but affordability doesn't make people lose their homes. Losing your home.
It just makes people lose their minds.
Yeah. Some people paying up to 50% of their income to mortgage. So what? I've done 56, 57, 70% DTI loans for veteran borrowers from like as long as I've been in the business. So we're saying this like this is some massive sort of new thing. The people that I worry about are renters that pay 50, 60% of their income towards rent, because rent's going to be more expensive next year. And I don't say that mean. I'm not saying like, let's worry about renters. Let's worry about renters, because they don't have the protection against higher rents. And most of them are not, saving at a rate that is going to enable them to become a home buyer or afford more going forward. So there's some valid points there, but it doesn't add up to what you want it to add up to.
Good stuff. Been on just over an hour. Want to take this time to ask a favor. If you found any value at all tonight, we've answered your question. You like being here, you listen to the podcast, any of that stuff, do us a favor and hit the thumbs up. Again, it helps the YouTube algorithm, helps push it out to more people, helps us accomplish our goal of educating. If you haven't been over to the Educated Homebuyer podcast, again, this is the YouTube channel is a little bit different than the podcast itself. The YouTube channel is all new content. It's a deep dive into specific topics on housing. It's not this. It's not my YouTube channel in the sense of giving you my thoughts. It's more or less fact-based information on housing. So everything from mortgage insurance to down payment to DTI to closing costs to the dream for all, any of that stuff that you want detailed information on. Next week, FHA versus conventional. It's a really good deep dive into that. So go over there and check it out. Again, same information on the podcast, but the difference in the podcast, the actual audio from that, is that this is transcribed every Friday and added to the podcast. So you can listen to it there if you want just the audio format of that. So hopefully all of that is helpful for you. But again, hitting the thumbs up helps with all of that stuff, and subscribing to the other channel also helps. So appreciate you doing that. All right, Josh, let's do this. I saw a good question here. You deal with a lot of VA loans. I was working with a lender who put me through a loan with Rocket Mortgage. I'm sorry to hear that, Antonio, but I'm now working with a different lender, but we're having trouble transferring the loan over for VA appraisal. Is it normal? So what do you have to have? Do you have to have Rocket release that appraisal in order to use it with the new lender? How does that work?
Yes. And this is a super easy fix. Rocket may be the biggest or second biggest lender in the country, but they do not want to get on the wrong side of the VA. As a veteran, what you need to do is contact the VA, call the regional loan center. So depending on where you're at, there's 5 or 6 of them around the country. You can Google, get the phone number. It takes about 5 minutes to get someone on the phone and say, hey, I switched brokers. They need to switch lenders. I need my case number and I need my appraisal assigned to the new lender, and they're hanging me up. And Rocket will get a not so pleasant message from the VA, and within a day or two, you will have what you need.
Wow. There you go. Good stuff. Monica, is there a limit? How many people can be on a loan, Josh?
It would be an overlay. Like Fannie, Freddie, FHA don't, to my knowledge, have such a limit, but there are limitations to the systems, including the systems that prepare your loan docs. There's only so many people they can put on a note in the deed of trust.
I used to hate back in the day when 5 or 6 people would try to buy a house together and you had all of this loan application. Oh my God, the disclosure, like there wasn't an easy way to do it. So you had all these different disclosures. You didn't have the, additional documents that just added a name. It was like, it didn't fit. It's tough. It's more work for sure, but I don't know that there's anything against it.
This will tell you that I'm older than Jeb, because you can't tell by the way we look. He looks older than me, but this will tell you that I am older than Jeb. When I started doing loans in the 90s,
carbon copy, guys, carbon copy.
Yeah, by pen. No, but it was all paper, and you would end up with a file folder with the forms echoed down, and it would be about like that big, like literally like a phone book, because we often had, so in Anaheim, which was my primary base at that time, $125,000 for a 3-bedroom, 1-bath home. And we would have a lot of folks that worked in the area, that worked at Disneyland, worked at the hotels, worked in the service industries around there. So it would be a husband and a wife with her sister and her sister's husband. Sometimes we would have 3. So oftentimes these people worked multiple jobs. So everything that Jeb said is true, but it's gnarly dealing with it in PDFs in a paperless system today. It was insane trying to get all real, legible photocopies back in the Flintstone dinosaur ages. Jeb, I read an article the other week that millennials are getting jobs, or not. What's after millennials?
No,
Millennials
there's no way. Millennials are not getting jobs. They're all lazy.
Well, the problem is when they get to
That's
the
what I heard.
office, they haven't been able to figure out how to use copy machines. One of them literally said they were there for about 15 minutes before they figured out they had to put it face down for the camera to be able to take the picture.
That is fantastic.
Yeah.
I remember we used to sit on them and
face down.
Too funny. All right. Let's see. Pulse Powered has another question here, Josh, about the Dream for All, saying, do you need to lock rates before you are reserve funds? My lender locked me without asking me. I could have locked now and be 0.375%.
I'm pretty sure we answered this question last week.
Yeah.
And answered it incorrectly. My understanding as of now, having gone through a couple of these, you are able to reserve funds without locking the interest rate.
All right. And have rates improved on the program in the last week?
Yes.
They have. All right.
So, I don't know about 3/8 lower. My understanding when they rolled it out last Monday, it was 6.375, and we just locked one today at 6.125. The 6.00 is for low income, and it was 6.00 last week, 6.00 this week. The only thing that changed was the standard income. So if you don't meet 80% or less of the area median income, you're looking at 6.125 today, and it was 6.375 last week.
All right. Chi came on and said, just want to say thanks for all the info.
Shay.
No, Chi. Chi. That's what I got out of that. It's like share, but shh. Just wanted to say thanks again for all the info. This time to both of you, being that I think Josh last night on Vetted VA. So keep up the greatness. You are welcome. Appreciate you being here. Josh, you turned on your lights again.
Yeah, I reached out to him for my iced tea. What I was going to say is we had 2 of the loyal Wednesday night viewers on the Vetted VA show last night. So for those of you who are veterans or interested in VA loans, every Tuesday night, 5 to 6 p.m. West Coast time.
There you go. Jacqueline, hey boys. Just a quick update on our Phoenix market. Contrary to many of the crash bros out there, our market is not crashing, seeing multiple offers again in certain areas, inventory still too low. So, Jacqueline, appreciate you being here. Jacqueline is a real estate agent in that market. I am actually fortunate enough to receive the Cromford report there in the Phoenix market from a buddy of mine. And I read it every 2 weeks or so and get an update on that market. And essentially, yeah, you have the same thing. It's more or less becoming a seller's market in, I think, a handful of counties out there, or a handful of cities out there, rather. And the market is starting to pick back up again. So it is not what many people want it to be, just because it's still a more affordable price point for a lot of markets. Yeah. And so with that, demand is still high. Josh.
Well, in support of that, like we don't say this because this is all anecdotal. This will happen in any market, the worst market ever. There will be homes that were underpriced, and this happens. But Melissa Monique says 17 offers on a house. I made an offer on 20,000 over. I went 20,000 over asking. The offer selected was 60,000 over asking, and we don't know. It could be a $4 million house, so 60,000 isn't very much, or it could be a $80,000 house, and that's an awful lot. But either way, we're seeing this. Like what the big one that was going around the news this week is the chart showing how cold West Coast markets are and then how hot East Coast markets are. I can definitely speak to the Northeast being hotter, and we've had some folks here, Jeb, on the show, in the Northeast area, and confirm that some of these areas are still really hot. But what I can say is anecdotal. This is me. This is my experience. I'm not dealing with any clients that are just rolling out and going, cool, I like that house, I'll give you this much, and getting an offer accepted. All of them are back and forth. Like the Dream for All one we talked about earlier, 3 offers on that property. It's not 50 offers, and it's probably not going to go any over listing. But of those 3, it's who's going to pay list and give us the best things that we want in that offer.
It was $275,000 in Lake Elsinore, Josh. So 20,000 over is what, 10%, almost 10%. 60,000 over is a lot more than 10%. What's that? 25%.
And like Jeb, the client that we were just talking about a minute ago that I was worried about the lock extension, he put an offer on a manufactured home in Wildemar, got outbid by $30,000. They went 20 over list, and it went 30 higher than what he had. So it's not to tell you you be prepared for bidding wars and to go higher on your offer. It's know your market. Work with an agent that
Yeah.
knows your market so that you can be prepared. Jeb, we had a client here that one of your team members is going to show homes tomorrow or showed today, and they were asking, like, how much do you think we'll be able to cut the asking price on it? And I go, well, where you're looking in LA County in the 650 price point is incredibly competitive. Your agent is going to be able to walk you through if that's at all possible, but I would be surprised in the current market based off of what I'm seeing from this side.
Yeah, and that's the thing. Like, guys, this isn't a push to say, "Hey, go out and buy a house." This isn't a couple of years ago where it's like, "Hey, if you don't buy the house, it's going to increase, significantly on the next one you bid on." A lot of markets out there aren't like that, and but at the same time, understand if you're in this market, it's competitive in a lot of places out there. Southern California is still very competitive. And I know you're seeing headlines like San Francisco's down 13%, LA's down 7%. Okay. It's not translating into any less activity out there, guys. But like Josh said, just work with a professional that understands the market and can guide you in the right direction. If you want to make lowball offers, I would tell you go for it. I'm not seeing any success. I'm not even seeing success where I'm making strong offers on properties on a lot of these. So just keep that in mind.
Again, this is all anecdotal here, so take it with a grain of salt. But Oso says seeing Alameda County, Bay Area over 100,000 over asking. And what do you see when you hear the Bay Area on the news? Super soft. No one wants to buy homes, and that may be the case in $2 million homes that tech employees would have been buying. But I know my first-time buyers that are looking in the Bay Area, they're not having a fun time of it.
Good stuff. All right, let's. We got TJ, Bankroll TJ is on a roll in the chat, just asking like 1,000 questions. So let's try to get to some of these. Really easy one. Suggestions on selling and buying at the same time. Selling, if you price it correctly in most markets out there, is probably going to be a little bit easier process than buying. If your house sells really easily in that market, it's probably going to be tougher on the buying side. Just being completely transparent, right? Because that means you probably have a hot market, probably a little bit more competitive on the buy side. If you're in a market that has some inventory, you might want to price it a little bit lower than market to try to get some activity. You might have a better opportunity to buy there. But I would tell you, if you don't want to be homeless in these situations, you might want to make contingent offers on you selling a property. You might want to have longer escrows, that sort of thing, to try to protect yourself against having those issues. You said, what do I think? You asked also the question of what do I think of selling and renting at the same time? I think that's okay, depending on what your plan is. Are you renting because you can't find what you want and you're just looking to take advantage of the market? Okay. I mean, I think that's okay. Are you renting with the expectation that, prices are going to crash and you're going to be able to buy something significantly less? If that's the case, I don't know that that's the right move. You could end up being a renter for an extended period of time. I've seen it happen. In fact, I have clients that sold a house in 2019 that never bought back in because they sold. They thought it was the top of the market, completely priced out. So just understand what you're doing. If you're selling and you're buying, you're selling and you're renting, look out there to see what is available to buy. Look out there and see what's available to rent. And not only just look out there, but talk to an agent about those and say, is this something like, hey, if I wanted to buy this today, would it even be feasible? Because if you looked at our market today, Huntington Beach, we only have 5 single-family homes, detached single-family homes with at least 3 bedrooms under $1 million. Only 5. And 2 of those, one is an REO, which is a foreclosure, not in a great location to start with. It's priced low for that reason. I wouldn't even qualify that as a property. Another one of them is a gutted property in downtown Huntington Beach where homes would typically sell for $1.75–2 million easily. Well, this house has no interior because it was a firehouse, not a firehouse, not a firefighter. There was a fire in the house and they gutted the inside of it. So there's no interior of it. It's selling for under $1 million. So out of the 5, you got 2 that aren't real homes. So you got 3 homes under $1 million. So if you looked at it and go, oh, there's a couple of homes I could buy. Guess what? All 3 of those homes, 2 of them have multiple offers. One has been on the market for 271 days because the seller isn't willing to entertain an offer less than his asking price, or their asking price rather. Therefore, it's sitting. So again, short way of saying just do your homework before you put your home on the market and accept something, because otherwise you could be in a bad position. Next one from Bankroll. That just flows. Next one from Bankroll. Do you suggest paying down points for a buyer if you are selling? Josh, what are your thoughts on this?
If you're selling, it really, the only thing that matters is what your net is. So that's going to be a cost. So if you can get a higher net profit, by all means, which whatever it takes to move the property, in my opinion, as a buyer, I don't generally want to pay points because it's a sunk cost, and I'm pretty confident that rates are going to be moving lower. But if the buyer wants them and it's going to allow you to net more, I wouldn't worry about what the cost of that is. Just like when we're comparing, I have 3 offers to buy my house. I don't really care what the offer price is. I want to know what they're asking and what I'm going to net and walk away from escrow with. Jeb, let me ask you a question. I'm sure you answered Bankroll's question correctly, but I was reading it as if I were to sell in the current market, because it's hard. Like you said, if I can sell my house easy, it's going to be hard to buy something. I don't want to be pressured. What do you think about going into temporary housing like the Oakwood apartments, where you put your stuff in a pod, put it in a storage unit, and say, I'm going to post up for 4 weeks, 12 weeks, 6 months, whatever it takes, so that I can go and find the right house? Like, to me,
that's okay. I mean,
the house, you know what I'm saying? The house is so important. I want to get it right. I don't want to be pressured.
No, and I think that's okay. I would tell you to look at the market and see what you can get out there for the price. I mean, is there a chance that home prices decline into the fall? Sure. I think that's something that could happen in some markets out there that have supply, more supply coming on the market. Those that have a tight supply, I don't know that you're going to see that decline. But if you're looking at the market now, say you want to sell, you're looking at the market going, I can't find what I want out there. You've got 2 options. One is you don't sell your house until you find it. Secondly is you sell and you rent something until you do. I just don't want people to get in the mindset of, hey, I'm going to wait until X time because of lower prices or whatever to find the house. If it's finding the right house and you understand that prices could go up, that rates could increase further, and that affordability could become a bigger problem, and you're still okay with that, then by all means, go for it. I just don't know, again, what you're thinking, but I also don't know what the market is going to do here over the next couple of months, because I do think there's an opportunity for lower rates. And I think lower rates likely lead to price stability at the bare minimum. Josh, here's another VA question. Got a couple of these tonight. House Hacker 619 says, can you guys explain to me what is VA escrow fund? I got a letter from some lender trying to get me to refinance with 2 months of no payment. So let's talk about there. Well, there's 2 things going on there. Let's talk about the first thing, the VA escrow fund. What is that?
An escrow refund is you have an escrow impound account. You have an amount in that account to pay for your taxes when they come due and your homeowner's insurance. If you pay off that loan, that will get refunded to you. So in essence, that's quasi cash back to you. 2 months with no payments, quasi cash back to you. There is no free ride. With the new loan, you're going to pay to reestablish the new account. So you put some money in your pocket, you added it on to your loan amount. The 2 months of no payments, no free ride. You're going to add the prepaid interest onto your new loan at closing. The follow-up here, Jeb, was he's got a 4.375 interest rate. Any company dumb enough to be burning money on mailers in the current market, they should have an idea of what your interest rate is based off of when you closed. They should know that rates, absent paying 3, 4, 5 points, are in the 5s right now. There is no world in which a refinance makes an ounce of sense for you. If you don't have a VA related disability that makes you exempt from the funding fee, you'll also pay a 0.5% funding fee on top of that and add that to your loan. They've passed multiple changes to the VA guidelines to try and stop hack companies like this from doing silly bullshit and abusing veterans. But if you're a veteran, if you're an FHA borrower, for whatever reason, they are the ones that get bombarded with stupid stuff like this in the mail. Do not ever respond to a mailer. You don't have to do a loan with me. I mean, we've talked about Rocket Mortgage here. Call Rocket before you talk to these idiots, because they are simply a boiler room set up to part you with your money in the form of your home equity.
Good. William B, was this did you put this question in? Josh, so we could mention the podcast.
Yeah.
What's the podcast name again? It's the Educated Homebuyer Podcast. So you can find it on YouTube. You can find it on what? I'm drawing a blank. Spotify, Apple, any of those places. You can go check it out. All right. Jason Kincaid says, can you sell your house and simply buy your neighbor's comparable house today? Sure. Yeah, nothing wrong with that. Yeah.
Jeb,
Easy
sort of
answer is yes.
a confounder there. It can make it difficult if you're buying a home, keeping your home and buying another home very similar in the neighborhood.
Yeah.
Underwriter's going to want to know, why are you buying in the same neighborhood? What is unique or better about this project? We at least have to make a case for them that there is a valid reason
But
that you
if
are
you're selling,
going to
you don't have that
yours
issue.
inoculated. Exactly.
Right. I'm about to purchase. This is from Unusual. I'm about to purchase my first home, and I have a close family friend who is going to co-sign for me, but he's elderly, nearing the end of his life. If he passes, will I have an issue, Josh?
Possibly. There's easy ways to avoid it. So if you put him on title, so he's going to be on the loan as a co-borrower, he does not have to go on title. You can be on title alone. I normally tell a co-borrower, never in any world do this, because by not being on title, you have no power, authority, ability to dictate anything. So if the other borrower who is on title goes into foreclosure, doesn't make payments, doesn't take care of the property, you have pretty much no authority there, but you have full liability. In this situation, he's elderly. You don't think he's going to be around forever. Less of a concern. If he does want to be on title, if you have him as a joint tenant and he passes away, joint tenant with right of survivorship, you are the owner as soon as he passes. You could also do something if you wanted to complicate it more, put it in a trust. The trust dictates that who gets it upon his death. But I would say either do not put him on title or take title as joint tenants with right of survivorship.
All right, there you go. Robert, 45% PITI gross, 70% PITI net, too high?
In this instance, Jeb, the question I like to ask, how much are you paying in rent and how much is the new payment? If you tell me that you're paying $1,500 a month in rent and the new payment is $5,000 a month at a 45 DTI, I start having concerns. My next question is, cool, while you were paying the $1,500 a month, how much a month were you saving? How much are you going to have in reserves after we finish this? I don't care about net. You may care about net because at the end of the year, are you getting a tax refund? Like, there's so many variables in there that we would have to add. By the way, we would have to add a tax refund into that. Some people just tell me, yeah, every year I get like 8 or 10 grand back from the IRS. I love it. I love loaning them $10,000 for the year. So from that perspective, Jeb does it right. Jeb takes a loan from the IRS and then writes them a big check at the end of the year.
God. So I'm not waiting. I'm not anticipating that document.
It's a good problem. You want to have a big tax bill. It means you had a good year. So 70% PITI net, no idea. I would look at how much you're increasing your housing payment, how much you were able to save. If it's a lateral move and no payment shock, no worries. If it's a big payment shock, hopefully you were able to save some money. Those would be the questions I would ask. In general, a lender is not going to put you in a position to fail because they want their money back. That being said, you know your situation and your spending patterns. Jeb, we've talked about this 9,000 times. You and I could be identical in every regard, income-wise, very different spending habits beyond what shows up on the credit report. And only we know what our comfort level is with a monthly payment.
Agreed. It's like you always hear, you never know like somebody's financial position. They look like they've got all the money in the world, but they've got credit card debt and everything else going on. Same thing here. Like, you just don't know somebody's position when buying a house, what their spending habits look like and whether or not they have some additional income that maybe isn't reported. There's multiple things that could be going on. Bankroll follows up with another good question here. Josh says, bought a new construction home 2 years ago, 2.5% rate. What do you think of renting it out? I think that could be something really nice, but it depends on what's the cash flow look like? What can you rent it out versus what is your mortgage? And at some point you turn that into a rental property, in order to get the capital gains at some point in the future, right? If you have it as an investment property longer than 5 years, you have to, your money is locked up in that with regards to any appreciation that you've gained through that period of time. And you have to do a 1031 or what have you, and in order to avoid any taxes when selling it. So there's multiple things to think about here. I like the idea of having a 2.5% interest rate on an income property and keeping it for as long as you can, assuming that the numbers make sense. But do you need the money to buy another one? There's a lot of questions going on there that I think you need to ask before just saying yes or no. Josh, here's one. I should be ready to buy a house in my area by the end of summer, but the neighborhoods I'd really like to live in have had no houses for sale at all for the last couple of months. Am I stressing too early about this? So not really a question we have a solid answer for, but thoughts on it?
My answer to it is you should never stress about things you have no control over. You stressing about it.
Josh is telling me that. This guy stresses nonstop. Holy crap. I shouldn't even have thrown this question to him. He's probably stressing talking about this question.
I'm paid to worry for other people so they don't have to.
This guy, I worry about nothing, man. I just live, bro. I feel like Matthew McConaughey in Dazed and Confused or something. No, should you be worried?
I keep getting older. They stay the same age.
I wouldn't be worried, but it is a reasonable concern. I think, what happens is typically during this time of year, inventory starts to pick up. It peaks during the summer months and starts to slow down again as you head into the fall. At the moment, you're not seeing inventory pick up in a lot of markets out there, which means come summer, are you going to have more homes on the market? Hard to say. I think you're always going to get some new listings on the market, but what happens is if you have less listings coming to the market than you have demand, right? Going back to that whole supply demand equation, you're going to have competition when trying to put an offer in on those properties. But at the end of the day, like Josh said, should you worry about it? No, you can't. There's nothing you can do to change it. So just focus on buying when you're able to, when it's the right time for you, and then deal with what you have to at that time. Josh, this is a question here that, when will prices go down in the Central Valley? So the Central Valley, we're talking Palmdale, Lancaster. Is that what we're calling Central Valley? Is that Central Valley, California?
Fresno,
Is that North?
Fresno, Visalia, Tulare.
Oh, that's what I meant. I said the wrong thing. Yes. What are your thoughts on that, Josh? That's probably the most affordable market in California. So
there's an underlying premise there. When you ask me when something will happen, you are supposing it is going to happen. Because of what Jeb said, it's one of the more affordable markets in the country. You would need basically a recession specific to that area where incomes go down. But for all the reasons why we talk about, all of the country is somewhat similar in that regard. And then I would assume that people in the Central Valley are also sitting on record levels of equity at record low interest rates and are unlikely to want to let their home go at a lower price. I would not worry about homes doubling in the next 10 years. I also would not hope or think or believe or expect that home prices are going to drop more than 3, 4, 5%. And even that would be in the extreme markets. Maybe a super appreciated market like a Boise, like the Bay Area high end based off of tech stuff, Austin based off of high end tech stuff. Maybe they could see a 10% downturn. But for the most part, all of those homes are in strong hands. They're not likely to cough them up at a discount or lose them involuntarily. To see a widespread downturn in home prices, it largely requires forced selling, and we don't have a recipe for forced selling. So I would rephrase the question and say, how do I get myself into a position to buy in the Central Valley at current prices versus when our price is going to come back down to me?
There you go. Good response. Melissa with another good question. Is it common to have issues with sellers that want rent back for 10 days or more? I don't trust that they will leave and turn into squatters. So I would say in my experience, I've dealt with a lot of sellers wanting rent backs, and I've, knock on wood, never had the issue of squatters. Could it happen? Absolutely. Is it likely to happen? I would say it's probably at the lower end of the spectrum, unless you in a situation that, people have issues with regards, like foreclosures and, defaults and that sort of thing. They're already in a bad position. I think it's probably more likely to happen in those situations. Nothing really you can do to, create any more, what's the right word? To give yourself any sort of relief in this situation. And you could ask the seller to put some sort of deposit into escrow, at which point they move out, they get it back. But if you're in a position where you're trying to get your offer accepted, probably, don't want to go in with that in mind. Otherwise, the seller is not going to look very highly upon your offer in most cases. But I would say it's normal. 10 days is not really a big deal. Find out why they need additional time. Are they just waiting for their house to be built? Are they, have something already out of state and this is when their jobs start? Like, what is the reason? If their reason is reasonable, then I don't think there's much concern there. If it's because they haven't found a house and they need more time and whatever, then maybe it's a little bit more of a concern. But even then, I think most people do the right thing. So less of a concern for me as an agent. That would be the conversation we would have, but to each his own in that situation, and something that you have to, consider for yourself. So Josh, there is definitely a mindset out there of renting forever and never being able to afford houses. I mean, we're seeing a couple questions here, so we're going to address this. Is how real is the narrative about institutional investors and cash buyers in general snapping up homes everywhere and forcing people to rent forever? So that's one side. Then you got flight simulation experience saying, do you predict a scenario where everyone will be priced out, where our kids will be renters for life unless people move out of the US? So go whichever direction you want to go with that.
So the institutional investor thing is real. Like, we have the numbers. We know Black Knight, a couple of the other big groups, have bought thousands of homes. They're concentrated in certain parts of the country. Those parts of the country where homes were cheaper and rents were higher relative to those home prices. That being said, Jeb, we did the collaboration a couple of weeks ago with Michael Zuber. He's in the Central Valley, in that Fresno market is where he buys. And he said towards the end of the last cycle, whether it was 2011, 2012, he saw institutional investors coming in there and driving up prices. So anytime you see affordability with strong rents and a decent economy, it's true. There's no two ways around it. And it has been a bad thing. I'm not a big fan of government intervention, but it would not have been a bad thing to sort of put the brakes on it at least. It's not too late. That could happen, but one never knows. In terms of everyone being a renter, I don't know. I like to say markets are self-correcting and will come back around that way, but we have some problems in that we didn't let it be a free market. So part of how we have all of these homes in strong hands is that people have really low interest rates, that the government put them lower than they should have been. Prior to COVID, rates were in the 4% range, plus or minus. So they were really good before then. And they went even lower based off of government intervention. But if they were at 4%, people would be happy to sell at 5%, more sales. If rates hadn't gone so low, if Black Knight wasn't able to control billions in financing at 1.5%, 2%, they wouldn't have bought as many homes. So I would like to believe that the market will correct. I'm less hopeful about that because we have distortions that will take years to work their way through the market if our government decides to stay out of the way and let the market forces take effect from here forward, which I'm not convinced they will.
There you go. I think that's a good answer. Nothing for me to add. Danny J says, thinking of applying for the Dream for All. Should we jump on it now? Even with the current market, I am in the low income moderate range. So I would tell you, Josh and I have tried to punch holes in this program multiple ways. I think if this is the way that you end up buying a house, I think it is a great opportunity to become a homeowner. The one thing I'll tell you, the only thing I can tell you reason not to do it is that if you plan on only owning that home for a couple of years, if you think it's going to be your home for the next 7, 10 years, 5, 7, 10 years, I think it's a great opportunity to become a homeowner. If you're thinking, hey, it's something I'm going to do for a couple of years, I'm going to sell it, get this appreciation and move on, I don't know that it's the right thing. Josh, anything you want to add on it?
No. What I would say is the opportunity is probably past. already. So if you're thinking about it today, you probably don't have that opportunity. If you call me tonight, we get off the show, you get me everything. And I'm going to say me, any lender, and they don't have a line of 14 others they're working on, and jump on it and tell you in the morning, cool, you're approved for X, go find a home priced for X. Jeb, for someone at the low moderate income, is probably looking at an entry level home. How likely are they, if we think funds are going to be gone in the next 10 days, to have a contract in hand in the next 10 days?
I mean, here's the thing, is that the lower price point homes, the more affordable homes, and I'm going to say if you fall in that low to moderate income, you're, and I'm just guessing, this is not fact by any means, you're probably in that $200,000 to $300,000 price point. Those are going to be the most competitive markets out there, hands down, because of this program. So Josh isn't saying that the time has passed because you can't get a loan approval or you can't have a conversation with the lender, because you can definitely do that. The problem is finding a property. That is what's going to take the time here. It's getting into contract on something. So that is, you got a lot of people. Like earlier in the show, we mentioned the story of an agent in the Bakersfield market listing a home under 300,000, 14 offers, 10 of them were Dream for All. So guess what? I don't know if the Dream for All guy got it. I don't know the answer. Did you know? Did they get the Dream for All? Did they go a different direction?
No, but I'm talking to Adrian tomorrow. I'll ask him.
Okay. So ask him, because let's just say one of the Dream for All got it. Guess what? There's 9 other people out there, Dream for All, that did not get it. And guess what? They're still looking to buy a house. And so while those 9 have been bidding on that house, guess how many people have gotten approved? And this isn't, I don't want this to sound negative, because I know it does. I know it sounds really bad about how quickly this is going to go, how fast, how all of that. Because it's just it's a very negative way to think. But the reality is that's how quickly it's going to go. There's a lot of people out there that are going to use this as an opportunity to become homeowners and take advantage of it if they can find it. So I would go opposite of Josh and say, you haven't missed the boat. Get approved if you want to use it, but also be in the mindset that it may not happen because it might be tough to find a property.
Well, Jeb, I can just honestly tell you, most people, let's say Danny calls me after the show tonight. So I'm going to be here till 9 or 10 talking to people on the phone and setting up files, because everyone wants this and we are running out of time. So I can't go, I'll come in the morning and do these. If we talk tonight, he'll probably, and again, I'm generalizing, Danny, I do have people that will jump on and send me exactly what I need and the application within about 10 minutes. But most of them go, okay, they start the application, they finish it the next day, send a couple items over the next day. So now we're Friday, and Saturday or Monday, I have everything. And now we're coming back for the show next week and saying, hey, money's gone. So if you are serious about it, and think about it this way, Jeb's assistant was showing these people today, they haven't made up their mind that they're going to buy, but we talked about it. It says, if you want it to be an option, let's do this. And she jumped on, got me everything within 48 hours. We ran through the numbers. Here's what you're approved for. And they're out looking, and they're going to decide tomorrow, are we moving now, or are we going to forget this program and come back early part of next year? So there's not a problem with saying, I want to give it a shot, and then getting out there and deciding wasn't right for me. But if you are listening, and not just Danny, anyone else, if you're listening and you think you want to do it, do it. Like, jump in aggressively, do the application, provide the documentation, find out what you qualify for, get with a good realtor and go look at some houses. Doesn't mean you're going to do it. It doesn't mean it's the right thing for you. But if you don't pursue it that way, you're making a choice by not doing that. The choice is, I'm not doing it because I'm not jumping in aggressively today.
Yeah. And again, this is going to sound very self-serving. But if you want to get in touch with Josh, you want to get in touch with a lender, maybe you're not in California, you don't even know what the hell we're talking about. That's okay too. There's a link scrolling the bottom if you want to talk to a broker or want to talk to a real estate agent in your market when you're ready. It doesn't have to be now. It could be 6 months from now. It could be a year from now. You can use that link, get in touch with somebody that can help you. So that'll scroll the bottom and you can use it at your leisure. But Josh, we had another question here that I thought was good. Something that's another plant, if you will, with 10% down and credit scores at 680. Do you recommend FHA now over conventional? In fact, I don't even want you to answer the question. I want you to give the right answer. What would the right answer to this question be, Josh?
Listen to the podcast when it releases next Tuesday at The Educated Homebuyer or at youtube.com/at The Educated Homebuyer. Is that the right answer, Jeb?
That is the right answer. We did this today. FHA versus conventional. We actually go over scenarios like this in that podcast, when you should consider one versus the other and what you should really do. So check that out, because that's really the answer. It's going to give you everything you need to know in there versus hammering it down once again.
And Fred, just so you don't have to wait until next Tuesday, 99% chance that yes, FHA is the right answer, but run the numbers and compare and listen to the podcast next Tuesday.
Yeah. Just compare. The numbers never lie. That's the key takeaway. Josh, or have we met our limit here? Are we done?
We've got a couple questions here. I don't know where we're going to go with this, but let's, Ricardo Rodriguez says, question, maybe my memory is a little fuzzy, but when recessions actually occur, are they as apocalyptic as certain YouTubers are conveying? Think Mad Max. So if you're watching videos and you hear everyone saying, well, recession is coming and this is going to happen and this is going to happen and this is going to happen. Unfortunately, we are in a world that is all about clicks. And if you don't say something incredibly sensational, it doesn't get clicks. A garden variety run-of-the-mill recession is not much to talk about. You know, it's not a lot of fun. A few people lose their jobs, not a lot of growth. Your stocks aren't doing real well. But it's more like a mild depression versus I need to go get the Prozac out. That being said, people like to go back to the last major recession. So there was technically a recession during COVID, but COVID induced and it was over in like 6 minutes. We were more concerned with being locked at home and not being able to do anything fun. But the last one prior to that is 2008. It's known as the Great Recession for a reason. It wasn't a depression, but it was closer to a depression than your run-of-the-mill recession. So from that standpoint, no, they're not anything near what they're made out to be. Now, that being said, you know, we talked earlier in the show, one of those fingers of instability that could lead to a recession would be commercial real estate. And if you're in the small bank business, if you're a commercial loan officer, if you are someone who is a property manager, an owner of buildings, like when you're in the industry that causes the problem, it's bad. But who knows what that's going to be for the next recession and or when it's going to come.
Agreed. Another thing to note, recessions are deflationary. So recession happens, inflation comes down. With that, what happens during recessions? The Fed typically does some sort of quantitative easing, which basically means that they're, trying to stimulate the economy. They do that in a couple of different ways. In the past, they've bought mortgage-backed securities. They've bought treasuries. They've lowered, the Fed funds rate, which in turn has impacted a lot of different things out there. So along with the bad, and I don't want to say that any of the stuff that I just mentioned is good, because that creates additional issues, like it did during the last, during the pandemic. So just, there's a lot going on. There's this time, if this recession could be a lot different than any other recession we've had, because there's so many different things going on with government intervention and just crazy things that have happened over the last couple of years that we've never seen before. So it's hard to say what it looks like. So just, I would say, like we said, you can't worry about the future. You can't worry about it, but, just be prepared, have some money in the bank, have some cash if there's opportunities out there that present themselves. And I'm not talking about housing necessarily. It could be talking about stocks, could be talking about anything that you can put money in. Fortunes are made during recessions, like big fortunes, if you have the chutzpah to put your money out there. $5 super chat. Is it okay to buy a tenant occupied house? What's the downside? My realtor told me we can add as a contingency. What if the tenant is leaving? So is it okay to buy a tenant occupied house? Yes and no. If you are buying it as an investment property, the tenant is staying in the property as your tenant. I would try to get the I'm drawing a blank, Josh, on the rent roll. What's it called? The
market rent?
No, it has the basically the past rents. It has a name. It'll come to me in a minute. But anyway, get the past rent roll, show that the renter's been making payments on time. Is that market rent? Are they willing to pay more rent for the property? That sort of thing, right? That's typically what you want to do. If you're buying the property to live in and there's a tenant in it, I don't like the idea of buying a property with a tenant in it without the tenant being out prior to me buying that house, especially in a state like California, where it's very tenant friendly and you have to deal with, them not getting out of the house for one reason or another. So, to each his own. Trust your agent that they actually have your best interest in mind in that situation. That's what I would try to focus on. But again, I think there's two different things going on here. For the tenant that is going to be in an investment property, you can find out, have they been paying their rent? How much did they pay? All of that stuff, because it's important. If they've been past due, not making their payments on time, all of that, then probably not the right home. And then as far as owner occupied, just make sure they're out before you get in. That's my advice, but I'm not your real estate agent, so it's not really advice. Just two friends talking. Hope that helps. Josh, we are an hour 49 and I'm going to take this minute once again to ask, if you haven't done so already, to hit the thumbs up in the video. There's 193 of you and there's only 83 likes. So that means there's 110 people watching just right now that don't even care for us, Josh. They haven't taken the time. So this one goes on to say, I move in as soon as the contract settles. So you want that tenant out before you buy the home, in my opinion. So before you close, tenant needs to be out of the property. And then you need to be able to do a final walkthrough on it. So in theory, they're out 3 days before you close on that property to give you enough time. Just two friends talking. Talk to your agent. See what they say. All right. Some of you came in. 11 of you came in and hit the thumbs up. That was nice of you. Appreciate it. Josh, a couple more questions here. Oh, what do we got here? Comment from David. David's a regular viewer here. Just says home prices in Northern California haven't softened outside of the homes at the top end of the market, which needed to happen to get more entry, what needs to happen to get more entry to mid-priced inventory to be built? So Josh, comment there about higher price homes coming down. That doesn't help the lower end of the market. What needs to happen for that to happen? Builder incentives. The state needs to offer, they need to make it less costly to build homes, offer tax benefits, offer that sort of thing. I mean, that's really the answer, but not likely to happen.
So you're in Northern California. The California government has decided what we should do is, rather than look to the places where we have open land and make it easier to build there, that we should just pack as many people as possible into existing cities and do that with high density housing, which no one has ever asked for. I'm pretty sure that if we scroll through the thread here of everyone who viewed tonight, no one said, hey, what I'm hoping for is a condo in a 4-story building. Maybe if you're in New York City, that's your plan and expectation. But for those of us in California, it's not. But again, expedited planning approval. But there's just so much bureaucracy and red tape that I was speaking with a client earlier today, and he said, well, I work in the construction industry. We build multi-purpose buildings or multi-purpose rooms for schools. And he says, what if, our industry, like, we're ready to go. We could do this. We could build more houses. And I go, it's not a matter of the companies having the manpower and financing to get them built. It really comes down to the regulations and restrictions, and not just land use, land cost also. It's very hard. We've talked about it on the show. Median prices for new homes have gone up much higher than median prices for existing homes, because the ones that are being built are the most profitable, which are higher end, bigger, that type of stuff. So you asked a very specific question, and I just said there's no answer. So my apologies for being a Debbie.
Yeah, no, we don't really have the answer to that, unfortunately. We all wish there was a little bit more affordable housing, but at the moment we're not really seeing it. So Josh, an hour 52 on, 99 people have liked the video. We've mentioned the podcast YouTube channel for you guys to go check out. I think we have like 600 and I don't know how many people have subscribed to that channel, 600 and something. Obviously we want to build that channel as well. We'll start doing lives on that channel at some point in the future, but it'd be nice of you guys to go over there and like that. If you like this content at all, it's very similar, a little bit more detailed. We've mentioned the podcast coming out next week, FHA versus conventional. The one that posted this past week was refinancing, when it's a good time to refinance. All these things are coming from your questions, so that's why we're doing them. But Josh, where would you like to leave people with today? What would you like to leave them with? Not where. We'd like to leave them where they are.
I think we've got improvement coming. And again, the mortgage side of it.
In what capacity?
The mortgage side of it, again, we're vultures. You want the bad news. I think employment is going to soften. I think the Fed is going to back out. I meant to throw it in the charts for tonight. I forget, someone has a market survey of participants. So it's not as good as the Fed funds futures market where people are betting with real money. But the survey, it's a 66% expectation of a Fed cut by June based off of the data over the last 7 to 10 days. I'm not there yet, but we've talked about this. The Fed doesn't directly control mortgage rates. The direction of inflation does. And the Fed will be out of the market when it's clear that inflation has been beaten. And I think we're getting close. When we get to the beginning of June, if we get more of this data, the data we saw this week is great. We expected it to come, but you can get a head fake. You can have 1 month and then we have hot employment numbers again next month. Don't expect that to happen. But when we get through May and we have weak numbers for April, weak numbers for May, we can start to call that a trend, and June will be a strong confirmation. And at that point, that survey and the Fed funds futures will be at like a 90% chance of a cut in June. I'm not saying that's the direction it's going to go. It largely depends on how weak that information is. And I don't expect it to be incredibly weak, but it's going to be weak enough that the Fed can go, okay, we've got things on the right track. Let's step back and watch for a minute.
But what you can't have is things move too quickly to the downside that re-stimulates growth in the economy, which again pushes inflation up because that creates additional issues long term. It keeps the Fed their hands in the cookie jar for much too long. So next week, here's some important information. Next week we won't be here, guys. There's CPI data. That sounded really country. CPI data coming out next Wednesday. It's important news. Unfortunately, we're not going to be here. I'll be out of town, kids' spring break. I'll be in Palm Springs, hopefully sitting by a swimming pool at 7 o'clock at night because I hope it to be 90 degrees at that time, which means it'd be 100 during the day, and I'm okay with that at this point. So we'll be back the following week, which is the 19th. We'll be able to update you from at that point on everything going on. If you have questions before then, feel free to reach out to Josh and I. There's a link scrolling the bottom now. But until then, guys, we appreciate you. Appreciate the support.
We have an essential question, Jeb, that must be answered before we go out. The Clippers will win, and if they don't win, they're still better than the Lakers. So, okay, now adios, Jeb.
No, that wasn't a question to me, bro. You just
Lakers
told me what was going to happen.
Lakers versus Clippers. Who do you